Hello, and welcome back to The Edge, the podcast where we explore what truly separates the masters from the average in business and finance. Today, we're tackling a topic that financial textbooks often miss: the human brain. I'm joined by Dr. Elena Vasquez, a specialist in behavioral finance and trading psychology. Elena, thanks for coming on.
It's a pleasure, Alex. This is the conversation that should happen before anyone even opens a brokerage account.
I agree. Our core material today asks a powerful question. What do people like Warren Buffett, George Soros, and Peter Lynch actually have in common? Most people would say billions of dollars or some secret algorithm, but you argue it's something else entirely.
Absolutely. It's the mindset. Imagine you strip away all their Bloomberg terminals, all the sophisticated algorithms and big data models. All they have left is their brain and a sheet of paper. They would still figure out how to generate wealth. The truth is, your most crucial asset in the financial markets isn't in your portfolio. It's in your prefrontal cortex. It's how you react when the market environment inevitably changes.
That's a powerful distinction. So let's get into the specifics of that elite mindset. The first killer you identify is discipline. Why is routine and a plan so much more important than raw intuition or market knowledge?
Because in the markets, emotion is like an engine without brakes. Your natural instinct is designed for survival, not for maximizing long-term profit. When prices drop, you feel fear. When they rise, you feel greed. Discipline is the brake and the steering wheel. Think of it this way. Are you a marathon runner or are you someone sprinting to catch a bus?
I like that analogy. I'm usually the one sprinting for the bus, reacting to the immediate stimulus.
Exactly. The bus runner has explosive short-term effort. The marathoner, the disciplined investor, has a rigorous race plan. They know their pace, when to hydrate, and when to conserve energy. An elite investor never improvises. They have a pre-written trading plan that defines 3 things before a single trade is placed: the entry criteria, the stop loss, the maximum you'll lose, your safety belt, and the take profit goal. If a trade doesn't meet all 3, it doesn't exist. This eliminates 90% of impulsive decisions.
That brings us perfectly to the internal enemies, the cognitive biases. If discipline is the shield, the biases are the arrows aimed right at our judgment. What's the most costly bias you see in everyday investors?
Without a doubt, it's loss aversion. The work of Daniel Kahneman and Amos Tversky showed us that the psychological pain of losing $100 is roughly twice as intense as the satisfaction of gaining $100.
That feels incredibly true.
It manifests in 2 critical capital-destroying ways. First, you hold on to losing assets, hoping irrationally they'll get back to even so you don't have to admit the loss is real. Second, you sell winning assets too quickly to lock in the gain, missing out on massive long-term growth. The winning mindset flips this logic. It cuts losses quickly, like a cost of doing business, and lets the winners run.
And what about the other major trap? Confirmation bias. I feel like social media has amplified that significantly.
It absolutely has. Confirmation bias is the tendency to seek out, interpret, and remember only information that confirms what you already believe. If you think a stock is going up, you only see the bullish news and ignore the analyst warnings. You create an information bubble. To counter this, you have to be actively humble. Read the bearish reports. Look for authority sources that contradict your thesis. Only if your idea survives that rigorous intellectual attack is it ready for execution.
Let's talk about that execution, specifically the guardrails. You focus heavily on risk management, making it a quantitative exercise rather than an emotional one. What's the fundamental rule everyone needs to adopt?
It's the rule of 1% or 2%. Your primary goal is not maximizing profit, it's preserving capital. The most fundamental rule separating amateurs from experts is the unit of risk. You should never risk more than 1%, maybe 2% at the absolute maximum of your total capital on a single trade.
Walk us through that practical example.
If you have a $10,000 portfolio, your maximum loss on any single operation, the distance between your entry price and your stop loss, must not exceed $100 or $200. This is non-negotiable. Why? Because even if you have 10 losing trades in a row, you've only reduced your capital by 10 or 20%. You stay in the game. The amateur gets greedy. The professional is consistent.
So it's about being able to absorb the inevitable shocks without being wiped out. It's also about having that risk-reward ratio defined, right?
Precisely. Never go into a trade hoping to win $100 if you know you could lose $100. That's a 1-to-1 ratio. You should always be aiming for 2-to-1 or higher. If you risk $100, you should be targeting a profit of at least $200. That is how you build long-term sustainable wealth.
Elena, we've covered discipline, neutralizing biases, and managing risk. To wrap up, you emphasize the combination of authority and humility. Why is that the final essential ingredient for a winning mindset?
Because the market is a living, breathing ecosystem. An investor who believes they know it all is one step away from ruin. Authority means you base your decisions on reliable sources, the global macro tide, the actions of the Federal Reserve or the IMF. Humility, however, is the ability to admit you are wrong. The great trader Paul Tudor Jones called it the ability to play defense. You recognize the mistake, you take the small loss defined by your stop loss, and you integrate the lesson. Arrogance, not ignorance, is the leading cause of bankruptcy.
That's a powerful final thought. The true test isn't knowledge, it's the execution of the plan, even when your emotions are screaming at you to do something else. Dr. Elena Vasquez, thank you for sharing these incredibly practical and important psychological insights.
Thank you, Alex. It was a great discussion.
That was Dr. Elena Vasquez on the winning mindset. Now you have the knowledge, the challenge is the execution. Are your investment decisions based on a plan or on emotion? Take that question and start investing in your most valuable asset, your own mind.